Confusion in Europe ahead of the Eurozone debt summit with proposals from all sides. Are any of them credible enough to resolve the current situation? Is it a leadership problem or structural crisis in Europe? This is Inside Story. Hello, I'm Stephen Cole. Leaders of Germany and France have come up with their new big idea to save the euro. But a leaked report ahead of a crucial EU summit revealed that the European Council President, Herman Van Rompuy, has proposed a fast-track fiscal compact that doesn't need national referendum or ratification by parliaments of each Eurozone country. His proposal includes the following four main points. Eurozone members should reduce their budget deficit below 3% of GDP and their national debt under 60%. There should be a golden rule to guarantee a balanced budget in the medium term. The Eurozone members can borrow directly from the European Central Bank. And finally, the European Commission will be given the power to impose austerity measures on countries requiring bailouts. However, Van Rompuy acknowledges that more far-reaching reforms would eventually require a change in EU treaties. Yet, UK Prime Minister David Cameron has warned he won't sign a new treaty unless certain conditions are met.
They choose to use the European Treaty to do that, then obviously there will be British safeguards and British interests that I will want to insist on, and I won't sign a treaty that doesn't have those safeguards in it around things like, of course, the importance of the single market and financial services.
Well, Germany and France want all of Europe to follow a German fiscal discipline and only spend as much money as they receive in taxes and no more. Germany's Chancellor Angela Merkel believes the only way to achieve that is to enshrine the budget rules in EU treaties. That way the EU could get tough and impose stiff penalties on countries who go overdrawn. Another key issue is the role of the European Central Bank. If the ECB starts buying Eurozone countries' bonds on a massive scale, it would mean a radical change in its role, as it was not set up to be a lender of last resort or be used as an EU bailout fund. Well, some argue that in the longer term, greater ECB flexibility could lead to Eurobonds that pool Eurozone debt, evening out the current imbalances. But for now, Mrs. Merkel is against Eurobonds. She says they are no solution in this crisis. Her new plan seems to involve the EU guaranteeing the debts of its member states. Well, joining us to talk about all of that are our guests in Brussels. Ansgar Belker, Research Director, German Institute of Economic Research. Also in Brussels, Peter Klepper, Head of the Brussels Office of think tank Open Europe. And in London, Clem Chambers, CEO of ADVFN, Europe's largest financial website. Welcome to you all. So another week, another Euro summit to save the single currency. Clem Chambers first. Can European leaders, led by Merkel and Sarkozy, drag the single currency, as David Cameron puts it today in the Times, back from the precipice? Will it be peace on our time by the weekend?
I think it's already happened. The market has been moving ahead of all the major announcements by several days, sometimes up to a week or two over the last 3 months. We saw that last week on the Monday. Market moved 300 points, and then 3 days later out came the announcement that all the central banks had done a deal. The market's been rallying really hard. I mean, there's a lot of obviously background negotiations been going on for weeks. That information just gets into the market. You know, the banks find out about it, and it's already in the price. The price of the equity markets, the price of the bond markets, which have had a complete turnaround in the last few days, and the strength of the euro, which is still, relatively very strong, suggests that a deal has been done. And so I think the answer is the deal is in. Now it's only for the politicians to mess it up. So with a bit of luck, it's we'll have a big sweeping announcements next week, and everyone will say, we've done it over the weekend, when in fact it's been in process for a couple of weeks.
Peter Klepper in Brussels. Is the sovereign debt crisis entering a new phase with Contagion reaching the larger economies? And that's why there's now belatedly a sense of urgency. And as we've already heard, the deal has already been done.
Well, I don't share that optimism. I think fundamentally nothing has changed. We still have a very high public debt in Greece. We have high private debt in other periphery countries. So the Eurozone is still very much unsustainable. If there is some more positive market reaction, it is almost entirely due to the European Central Bank, which has been buying on a quite an extensive scale government bonds of, for example, Italy. And granted, if Eurozone leaders would decide on a larger bailout on, for example, combining the ESM and the EFSF, that would give some respite. But longer term, nothing of the fundamental problems of the Eurozone has been dealt with.
Ansgar Belka, is the time for pretending over now? This isn't any longer a liquidity crisis. It's not a morality tale contrasting thrifty Germany against feckless Mediterranean countries, but rather a north-south structural crisis caused by the faulty workings of monetary union.
Yeah, my view is that in principle the right things have chosen and decided upon with Merkel and Sarkozy to going ahead for a hard fiscal union as a precondition for having the monetary press in. But the problem is that of operationalizing this kind of stuff. For instance, you have to have the European Court, for instance, different views on the legal obstacles, no bailout, monetary printing press and its use for the public debt. This is understood differently by lawyers all around Europe. So I'm not quite sure how to materialize all these different views if it comes about to decide upon it. And one other thing which has not mentioned up to now to a sufficient extent with Merkel and Sarkozy is the lack of competitiveness of southern countries, because Greece, Portugal clearly suffer from a lack of competitiveness, and this has not been tackled right now. So Germans are biased towards the fear of inflation stemming from this kind of enterprises, bond purchases, at least in the medium run, because it cannot sterilize and it does not give enough incentives. And if the fiscal union is not waterproof, just going for the money printing press would hamper reform efforts.
Clem Chambers, should Germany now show willing and buy or guarantee Spanish and Italian debt, and in doing so, in a way, as some observers say, cross the Rubicon to fiscal and political union? Or will they ever accept the EMU should break up in some form, or some countries should leave?
Well, I mean, the issue of the euro crisis, there is a fix for all the problems that we see in the UK, in Europe and the US, and nobody really wants it, but there isn't another way out, and that is you inflate it away. You inflate the debt away, if you effectively default over the medium to long term using inflation. It's the traditional historic way governments get out of their debts. Ever since the Roman period, everybody knows it works. It's simple, it's straightforward. The UK's been doing it for nearly 2 years now. The US is about a year down that path. And Europe would be on that path. Greece would do it naturally. Italy has done it for hundreds of years. Spain would be doing it if it wasn't for the Germans saying we will not have inflation. So all the detail around the edge is not important. It's will Germany bow down and suffer inflation for a period of 3 or 4 years on behalf of the other countries that have basically bankrupted their public finances. And it's the fact that Germans refuse to do that that's brought about the structural problems in the euro, and the fact that Spain has to pay 7 or 8%, etc., etc. If the whole of Europe went on a money printing binge and had low interest rates, which is financial repression, and a 5 to 6% inflation rate, like we've got in the UK, for example, all those problems, those structural problems, go away after 5 or 6 years of austerity and inflation, stagflation, which you would recognise back from the 70s. Germany has said no to that, and I believe in the last couple of weeks they've said yes, we'll stand some of that, and we can get printing in the background to create this new dynamic, and that's what we will see over the next 1 or 2 years. Is you'll see suddenly inflation.
Pieter Klepper, print away, says Clem.
No. That's absolutely the wrong path. And people in Germany, luckily, realize that this has historically led to very bad outcomes. If you inflate, you basically let the whole society pay. And you don't put the responsibilities where they ought to be. We need to break the taboo that every major bank in Europe should keep in existence. That's crazy to let zombie banks just alive, even if they're completely insolvent. We have to let some of them go out of the system. That's possible. It has happened before. It has happened in the US, in Europe. we can perfectly work out how to save deposit holders and put the burden at shareholders and bondholders. That's what we should absolutely do.
You're saying some need to leave. Ansgar, the Eurocrats and the bureaucrats in Brussels keep insisting if you break up the euro, the European ideal is somehow threatened. Do you run with that?
Yes, to a certain extent I run with that, because Germany has always keep in mind that the European Union was the first offer to go in peace jointly again with the other nations after World War II, and this should not be forgotten. And anyway, if
they could not forget that. They could keep that in mind, but still have some countries leave.
Yes, some countries leave, but Germany should not be the first one to leave, because you can also imagine that a strong country could leave, at least in theory. But Germany would clearly suffer, besides the main arguments that its currency would revalue. The main thing is that in the rump area, euro area, then the ECB, the remaining ECB, would go for inflation and would inflate our returns to our asset away. And this is often forgotten. So I think that we have invested so many fixed costs into the existence of the euro area that we should be more tolerant. But let me just comment on the other speakers, on the tango between a government which can never go bankrupt because it can tax, and a central bank which cannot go illiquid because it can inflate. This is a very dangerous view, because if you have to go for a fiscal backup, which has been done in the US and the UK, the political independence, financial independence of the central bank is not guaranteed anymore. And what the Fed does is just to inject bonds into the Federal Reserve System in order to stabilize it, and very soon people would see that there's no worth in it, and this is a very dangerous situation for the rest of the world, because you have so much.
It already is a very dangerous situation. We're talking about trillions of dollars of debt, trillions of euros of debt. But how bad can this euro crisis get, and what does the crisis mean for ordinary people? Germany and France want all nations to balance their budgets, that is, to spend as much money as they receive in taxes and no more. And most importantly, cut their huge debt mountains. Greece, for example, is cutting its spending through cuts in education, health and bureaucracy. That's what Greece says. That means tens of thousands of job losses, leading to less money running through the economy, and people are spending less in the shops. Banks aren't willing to make new loans to businesses, and businesses then close down, making more people unemployed. Well, civil servants face salary cuts and social unrest spreads. It's hard to stimulate the economy and create jobs in situations like that. Dropping out of the Eurozone could restore competitiveness and get jobs back, but nations would still face pain, and the fear is that other weaker economies would follow suit. Well, Peter, European Council President Herman Van Rompuy claims you can introduce tougher rules to tackle the debt crisis without changing EU treaties. He thinks you can do it just with almost a codicil to a treaty. Is that possible?
Well, legally, it's controversial. He has proposed Protocol 12 to be changed, which is basically the excessive deficit procedure. Probably you can change, you can implement some of the changes with that. Possibly not all. That's legally controversial. I think more fundamentally, the problem is that although austerity is probably unavoidable and important, it is not going to solve the fundamental problems that the Eurozone is suffering from. And it suffices to look at countries as Spain or Ireland. They have more or less respected the Stability Pact, and still they are in trouble. Why? Because they have huge private debt as a result of the fact that interest rates were too low for them. So they were in one currency zone with a stronger economy, Germany, and they basically were on a different growth path. So when they needed higher interest rates, Germany needed lower interest rates. And that's something that is very hard to solve with budgetary supervision.
And Clem Chambers, Angela Merkel's plan seems to involve the EU guaranteeing the debts of its member states. Why is an idea like that acceptable when Eurobonds aren't?
Well, it's a sort of magic trick, isn't it? If Germany has faith in these dodgy bonds, then everyone will have faith in them. It wouldn't necessarily work. And yes, a guarantee still requires that guarantee to be paid if things do go wrong. And they have been going wrong. So if you are going to back it up with a guarantee, at the end of the day, someone's got to print money to back up that guarantee. And it always keeps coming back to, really, is Germany going to be on the side of the rest of Europe with the result of actually realigning the whole Eurozone? The thing about inflation, I'm not suggesting it's a good idea. I'm suggesting that's what's going to happen. That is the quick, well, it's not even that quick. That is the only practical fix that they have in mind to get this done. And Germany has been at loggerheads with the rest of Europe for historical reasons, for political reasons, and now that there is some kind of agreement about what is allowable going forward in terms of printing money, of monetizing debt, of actually sorting out these issues. So, Germany coming in and saying we're guarantee these debts, well, you are talking about hundreds of billions. If you actually had to write a check to guarantee a Greek debt or a Italian debt, I mean, it's 500 billion in the next 9 or so months. That would have to be potentially backed up. And then you add all these different countries. Well, at the end of the day, if you're called upon, you're going to have to print that money or default. And Germany's not going to default. So we're back to printing money again. Because the only way out of this corner is printing money.
All right, one-stop shop printing money. Ansgar, what's the role of the ECB here? Its primary role was to curb inflation. It certainly wasn't signed up to be a lender of last resort. So what part and what role should it be playing? Timothy Geithner, who's over in Brussels, in Europe anyway, to oversee all of this, he thinks there should be a bigger role for the ECB. Do you agree?
Yes, I agree. It should have a larger role in terms of unconventional monetary policies. It should take into account to inject more liquidity into the banking system immediately, because it's necessary, because the bonds are rated in the same way as the banks, and this is not justified at all. But as the experience with Trichet showed, that he aimed perfectly at price stability, but forgot about the financial leverage effect in the financial institutions, in the private sector, as the previous speaker has said. So there's a much larger role, but not for interest rate ceilings for sovereign bonds, because this is not unambiguous. What is the interest ceiling for Italy? Interest rates were higher in the 90s than they were now. But it should go for a limited time for liquidity support of banks, and rarely maybe for liquidity injections for governments like Italy, because Italy suffers from a confidence crisis, liquidity crisis, but not from fundamental problems. It suffers from a lack of political credibility. Look at the world political governance indicators, which have worsened tremendously in the last decade. So the ECB, Merkel should go for a limited maybe bank license for the EFSF. But at the same time, in exchange, go for a harder fiscal union, because this prevents governments from being too lax in terms of structural reforms.
Clem Chambers, this whole system was not designed to deal with a crisis of this magnitude, was it? We know that politicians lied at the beginning. Sarkozy admitted as much. He said, they fiddled the figures to allow Greece into the European Union. So if you didn't believe politicians then, why should you believe them now, I suppose? When are we going to see the truth, or do we only trust the markets to tell us what's happening?
Well, the markets obviously have got the inside track, because there are a lot of people in the political layer trying to sort this out, and obviously that's going to leak crazily to all the participants in the market, and they're the guys that are pricing in what is going on at the political level. So that is giving a lead indicator of what's going on, that is for sure. But remember, the Europe has always wanted to be more unified, and one of the moves for having the euro in the first place was that there would be a crisis, and that crisis would lead to a tighter welding of Europe more towards the United States model. So in many political minds at the very early stages years ago was that this event would occur, and at that point the EU could make a move to become more tightly integrated, and you are seeing that right now happening. And it makes perfect sense. I mean, you can be pro-euro, anti-euro, and that's politics. Economically, it makes a lot of sense. Economically, it would make perfect sense for the ECB to be like the Fed or to be like the Bank of England. It isn't a lender of last resort. It isn't a printer of last resort. Undoubtedly, it has to become that along the line. And it's political people's jobs to change the laws, to sort out the legalities and get it done. And they are trying to get it done. And you only had to see Merkel and Sarkozy a couple of days ago at that podium to know how painful that process is being for everybody involved. People are, in the political level, losing their jobs left, right and centre here, because to get this done is proving very hard. And they still might not get it done, and it still could all go horribly wrong. But I think the market is telling us that the people in the know think that it's all coming together.
Do you think it's all coming together, Peter Klepper, in Brussels?
No, I don't think so. And I think actually using the ECB either to provide money to the EFSF or the ESM or the IMF is a very bad idea. If you really want to bail out, which is not going to solve anything in the long run, but anyway, if you want to bail out, you have to do it through direct fiscal transfers approved by national assemblies who are democratically elected. If you use the printing press, if you use the ECB, you're going to undermine trust in the currency, and that's a very dangerous path to follow. It's also naive to think that you can somehow control inflation. You can government authorities can control how much money they bring into the system. They cannot control how much trust citizens have in currency, and we see time and over again, when there is inflation and higher inflation, maybe hyperinflation, that's always when citizens start having mistrust in currency.
Briefly, Peter, does that mean this new deal, this new fiscal union that Merkel wants, that every country in Europe will effectively guarantee everybody else's debts?
Well, we're definitely going in that direction if everything is confirmed, and of course then you have all kinds of moral hazard issues as well. We've already seen in the summer that the ECB started to buy Italian bonds. Italy promised to do some reforms and then they stopped, and then the ECB had to give a signal by not buying for a certain period until Italy took up the reforms again. So even in the very beginning, when Italy secured a huge concession from the ECB to start buying Italian bonds, you could see that there was a lot of moral hazard. So that doesn't promise anything good for the future if they go down that path.
And Clem, does that explain why S&P is minded to downgrade every country in Europe up to and including Germany?
Absolutely. What people have to understand, we are no longer in the world of economics. We're in the world of politics here. And politicians are not necessarily that great at economics. We've moved out of a world of economics. And since the balloon went up with the credit crunch, and particularly now with the sovereign debt crisis, it's no longer about real economics. It's about politics. This is all politics. You know, the fundamentals are most of Europe is very broke. America is very broke. The UK is very broke. And to fix that is going to take a complete realignment.
Paying the bills for keeping the euro on life support, how long will Germany keep signing the cheques?
So I don't think so that we are already so far that Germany will pay all the checks. But what Germany can do is to publicly resist against Eurobonds, because they won't bring so much and won't be attractive for investors, because investors still compare it to US investments and find them better, prefer them, because in Europe politicians always find new solutions and are not dealing with credible commitments. And the other thing is that banks are double as indebted in the euro area than in the US, and this does not serve for much trust in the Eurobonds. And on the other hand, Germany can still object against unlimited bond purchases without a limited agreement on a fiscal union, and by this making these bond purchases very expensive. So I don't think that the largest guarantor country can pay all of the checks, because we still have some options open. But the thing is that Germany, as I just mentioned, still benefits from the euro area, and the exit would be harmful because we have to depreciate some of our claims in assets in the rump euro area. But in the long run, I can well imagine a core union joined with France, of course, the main axis, and the Benelux, Austria, Finland, and the other countries pegged with exchange rate. If the adjustment process will be non-linear, very stormy, but in the end we can reach a better solution if we can threaten with the exit.
OK, the deal, according to Clem Chambers, has been done. But Peter, last word to you in a very brief one, is what do you want to hear from Merkel and Sarkozy, maybe Geithner, on Friday or Saturday?
Well, they need to break two taboos. First, they should break a taboo that every bank, every major bank, should remain in place. And secondly, they should break the taboo that government should not default. Greece has to default. According to the market, it will default. And they have to face reality, as bad as the consequences might be, because now it's cheaper to do it than in 2 years' time.
Bureaucrats aren't always good with reality, but we'll leave it there. Thanks very much to our three guests in Brussels, Ansgar Belke and Peter Klepper. Thank you both very much. In London, Clem Chambers. And thank you so much for joining us here on this edition of Inside Story. We welcome your comments and suggestions. Please email them to us at insidestory@aljazeera.net. From me, Stephen Cole, goodbye.